Hi everyone, I hope that you're doing well today. So I am going to be taking you guys through fringe benefits for today's session. So before we start with the question, I'm going to first take you guys through the notes and then we will do the question after that. So the fringe benefits are basically the benefits that you get from your employer by virtue of being an employee. So there has to be an employer and employee relationship before you can consider fringe benefits. And we are going to start with travel allowances. So you will consider travel allowances when there is a fixed travel allowance that an employer grants to an employee for an employer grants an employee a fixed travel allowance, and to calculate the business cost, how to calculate business cost must be deducted from the allowance received. So, for example, your employee gives you a total travel allowance of 5,000 rand for the entire year. To calculate the travel allowance that you actually have to include in your gross income is you have to take the total travel allowance of 5,000 less the business costs, which we are going to calculate as we go through the cost of the notes. So you first need to consider whether an employee keeps a logbook. If the employee keeps a logbook, then they will get actual costs per kilometer multiplied by business kilometers, and that will be your business cost that is related to the travel allowance. And you can choose between that actual cost or the deemed cost multiplied by the actual business kilometers. So your actual costs are the depreciation of the vehicle, as well as all the fuel and maintenance costs that the employee would have had to pay for. So those are the actual costs that we are talking about, which is your depreciation, or rather your wear and tear. If the employee does not keep a logbook, then the business cost will be the deemed cost multiplied by your business kilometers. So below we will calculate our deemed cost. So to calculate your deemed cost, you need to look at the cost price of the vehicle, including VAT and finance charges. And you then have to look at the table that is at the back of your tax legislation, the cost scale table that shows you what is the fixed cost of an asset, and you determine the fixed cost of an asset related to the actual cost price of the vehicle. So if the vehicle is somewhere in this tier, it does not exist 100,000, then your fixed cost would be 34,480. So the taxpayer, to calculate their deemed cost, you need to take the fixed cost, you divide that by the total kilometers that the taxpayer is said to have traveled, and you multiply that by 100. So you need to apportion for the number of days. So if the taxpayer got the travel allowance for 155 days of the full year of assessment, we need to apportion for the time, for the number of days. So after we calculate the fixed cost, we are going to say 154, which is the number of days that they got this travel allowance, divided by 365 days, being the full year. From there, you add your full cost, which is in that cost scale table, your maintenance cost, and you add that all together, and you multiply that by the business kilometers to get your business cost you get your business cost. You include in the taxpayer's income allowance received less the business cost that we've actually calculated. Your actual cost would be your wear and tear, as mentioned, and the actual costs incurred. Right of use of a motor car. The taxable benefit of a right of use of a motor car is the value of private use less the consideration that has been paid by the employee. So the value of private use is calculated as follows. So you multiply the determined value by either 3.5% if the car is not subject to a maintenance plan. And if it is, then you multiply it by 3.25%. So to get the value of the tax benefit, you're going to multiply your rate, the either one that is applicable, multiply by your determined cost, multiply by the number of months the taxpayer got the used for the vehicle for. So your determined value is your cost price. And from that, you can reduce that value that you just calculated above by the value of private use, by the value of business use, I meant. So you will calculate your private use by, let's take a step back. You'll calculate your private use by taking your rate, your percentage applicable, either 3.25 if it is subject to a maintenance plan, or 3.5 if it is not subject to any maintenance plan, multiply by the determined value, multiply by the number of months that it was used. From that private value, you can less that by the number of by a portion according to the number of kilometers that it was traveled for business use, to less to reduce that value of private use by the apportionment of the value that was used mainly for private use. You can then reduce that by your fuel cost, maintenance cost, insurance and license, multiply all of those by private kilometer traveled divided by your total kilometers. Right of use of an accommodation. So when an employee gets the right of use of an accommodation from their employer, they will have to include in their income the following amount, which is calculated as A being your remuneration proxy, and this will normally be given to you in the paper. But your remuneration proxy is basically the amounts that constitutes the taxpayer's remuneration, your salaries, your bonus, plus your fringe benefits and all of that. So your remuneration proxy will be remuneration as defined, and B being 95,970, and all this is stipulated in the text, the legislation, and C being 17 or 18, at least if the taxpayer is being given the right of use of at least 4 rooms and pays for electricity or furniture, and D being the number of months. So the right of use of an asset, if the employee is hiring or leasing the asset, the amount of rental payable by the employer for the period that the employee uses the asset will be the value of the fringe benefit. But if the employer owns the asset, then the value of the fringe benefit will be the lesser of the cost price multiplied by 15%, or the market value multiplied by 50%. Remember that you need to now apportion what we are going to get here for the period of use. For example, how many months was it used for? Was it used for the entire 12 months period, or was it used for a period less than that? Then you have your medical fringe benefit. An employer contributes to the medical scheme on behalf of an employee and dependents. Then the value of this fringe benefit is the amount of the contribution by the employer, and you will get no value. The tax, meaning that the taxpayer who's getting this fringe benefit will include no value if the payment was made on behalf of a person that is a pensioner, it was made on behalf of a dependent of the person after death of the pensioner, and the dependent, or it was made on behalf of the dependent of the deceased employee if the employee was employed. if the employee was employed on the date of death or if the employee was 65 years or older. Meals, refreshments, and vouchers. The value of the benefit is the cost to the employer, less any consideration that has been paid by the employee. So the taxpayer will then include no value if the meals or refreshments and vouchers in question were received in a canteen, cafeteria, dining room operated by the employer on behalf of the employer, or it was during business hours or extended working hours or special hours that could be during overtime and such and such. It is required to entertain client on behalf of the employer, or the board and meals were provided with accommodation, and they were dealt with as part of the accommodation benefit. Low interest loan, the value is the amount of the interest that would have been paid if it was at an official interest rate, less any amount of the interest paid by the employee. And B, you need to apportion this low interest loan for a number of months. So you will get a no value for casual loans or loans that are less than 3,000, or the loan was for the purpose of enabling employee to further their studies. Cheap or free services. The value of the benefit is the cost to the employee less any amount that has been paid by the employee. Travel facility granted by employer to enable the employee or relative to travel to any destination outside of South Africa, South Africa for private purposes. The value of the fare payable by the passenger, less any consideration that has been paid by the employee, less forward and return journey will be counted as one journey. Free or cheap services, you will get a no value if any facility provided by the employer to enable employee or spouse to travel. The transport services granted for the employee to travel from home to a place of work will also be a no value. The services rendered at work, the services are rendered at work for better performance. Benefit is enjoyed at work or recreational purposes that is used by employees in general. Any traveling facility granted to employee or spouse or child, any travel facility granted to employee, spouse, or child if the employee is stationed more than 250 kilometers from work, and the employer required the employee to spend more than 183 days at that place of work, and the facility granted travel between usual place of residence and place of work where it is stationed. So I'm just gonna go through the question now, and let me quickly open it. All right, so you have Miss Trix Galore, 33 years old and unmarried. So as I always say, when you're doing a question, every time you see that you're dealing with a natural person, you need to think about all the natural person's provisions. So you're dealing with Miss Trix, a natural person. You need to be thinking about the fact that when you calculate the tax payable, you need to use your tax tables, and you also need to think about your interest exemptions. And since this person is 33 years old, they're younger than the age of 65, then they will get a interest exemption of 23,800. You need to be thinking about your all the provisions that would be applicable to a natural persons. And this Miss Trix person is employed as a project leader by Can Count Limited, a provider of telecommunication product and services. The following information relates to tricks for the year of assessment ended 29 February 2024. So you need to now draw a timeline that the person's year of assessment starts on the 1st of March 2023 and then it ends on the 29th of February 2024. She earned a basic salary of 132 for the year, as well as a pensionable 13th check that is equal to her monthly salary. So they are telling us here that has this 132 rand salary includes a 13th check. So to show the market that you know your tax, you need to show a separate treatment between that salary and the 13th check. So the salary is so how I got to this 121 is that I took that 132, divided it by 13 to get 10,153 and multiplied that by 12 months to get the multiply that by 12 months to get the 12-month salary of 121,846, and I had to deal separately with the 13th check. So the salary will be included in the gross income of Ms. Trix in terms of paragraph C of the gross income definition, and you also need to include the 13th check as such. Trix contributed 42,000 towards the company's pension fund in respect of the current contributions, and her employer contributed 20,000 to the pension fund on her behalf. Assume Trix's remuneration amounted to 230,323. So she made a contribution of 42,000 and her employer then paid for her pension fund. So your employer paying for your pension fund is a fringe benefit in terms of the seventh schedule, and it will be included in your gross income in terms of paragraph I. So that 20,000 that their employer contributes for them in a medical scheme will be included in the taxpayer's gross income, right? And if you guys could remember from when we were doing individuals, when an individual contributes towards a pension fund, a retirement annuity fund, they will be eligible for Section 11 Cap F, the Section 11 Cap F deduction. So for me, I then decided that I'm going to keep track of what were the total contributions. So they told us that the total contributions, well, not entirely the total contributions, as we haven't yet gone through the entire question, but they told us that the contributions would be this 42,000 Rand plus 20,000 Rand. So the total contributions so far that I know of is going to be 62,000. And this remuneration is important because if you guys could remember from Section 11 Cap F, let's do a quick recap. So Section 11 Cap F allows for a deduction that is equal to the total contribution, but it is limited to the lesser of 350, or sorry for that, or the higher of 27.5% of the taxable income or remuneration. The remuneration they've already given to us. The remuneration, they said it's 232, 220, 220. Sorry for that, you guys, 323. That is the remuneration and also taxable income after capital gains. So this is what our section 11 cap F says. So just to keep, if I was in an exam situation, just to keep that at the back of my head. So on the 1st of March 2023 to the 31st of July 2023, 153 days. So if you could remember when we were talking about fixed cost, is that you need to apportion them for the actual number of days. And see here, they've already given you the number of days, and I can sort of see that this is going to be a travel allowance trigger. So Trix, on the 1st of March to that date, Trix used her own car to travel for business purposes. She received a travel allowance of 3,200 per month for this purpose. So her total allowances that she received were going to be from the 1st of March 2023 up until the 31st of July 2023. And her odometer reading on the 1st of March was 39,000, and at the 31st of July 2023, it was reading at what is this? It was reading at 53. So it means that we need to calculate the kilometers that have been traveled in the current year of assessment, so the total kilometers that have been traveled. And to do that, you need to take your odometer reading at the end, at the 31st of July 2023, less the odometer reading on the 1st of March 2023, which we get the value to be 14,235. And they say to us that Trix kept a record, an accurate logbook during the period she received the travel allowance. During the period she received the travel allowance, the logbook indicated that she traveled 8,400 for private purposes during the period. She owns an A3, whatever. She owns an A3D AU, which costs her 180. So the total kilometers that she needs to travel, she has traveled for business purposes are this 14,235 less have 8,402, which will give us 5,833. Right? So that is her business kilometers, and the cost price of this car is 188. So that's what we're going to use to determine our fixed cost on that cost price table. Trix borrowed an amount of 60,000 from her employer on the 1st of December 2022 to finance a portion of her vehicle. The company charges her a fixed simple interest rate of 5,000 per annum. On the 1st of March 2023, an outstanding capital balance was 54,000 Rand. So beginning of the year, the outstanding capital balance was 54,000 Rand. And if you guys could remember from the notes, we did mention that any low interest loan will be a fringe benefit. So we need to deal with the consequences of that as necessary. So the opening balance of this loan was 54,000. 54,000, and she made capital repayments on the 31st of July. So from the 1st of March to the 31st of July, 54,000, they charged an interest of 5%, and they've already given us below here the official interest rate. So the official interest rate is 8%. And then from there, we need to less the 5% that they charged her to calculate the fringe benefit. So sorry for that. Just do this. So that's from the 1st of March until the 31st of July, and that is 153 days divided by 366. It's the 2024 year of assessment. And she then made a capital payment of 10,000. So you also need to calculate that with the number of days accordingly. Right, so that's going to be 366 minus 153. If I'm not mistaken, 213 divided by 366, right? So on the 1st of August, Trix's employer provided her with a company car and ceased paying her that monthly travel allowance of 3.2. She was provided with a BMW with a cost price of 130. Another employee previously used the BMW. For 1 year, the employee was not subject to a maintenance plan. So we need to calculate the fringe benefit. So to calculate the fringe benefit for the right of use of a car, we saw that this one is not subject to a maintenance plan. So we need to multiply 130 multiply by 3.5% and then multiply by the number of months that it was used for. So she used it from the 1st of July to after the 31st of July. So that's like 7 months. Right? And Trix has been living on one of her employer's 3-roomed houses from the 1st of March 2023 to the 31st of January 2024. The house is unfinishable and she had to pay for her own power consumption. Trixie's remuneration proxy, they've given you the remuneration proxy to be 174. So you now know what your B is. A is remuneration proxy, not me lying. Is it? That's remuneration proxy. B, it's at 95,000. C, it's going to be 16 or 17. Let's quickly check on our notes. Um, 95,750. And then C is 17. The number of months, so 1 March until 31, so I think it's 11. Trix received 500 per month to entertain clients. During the year, she spent 6,750 on entertaining clients. So this will not be included into her income because it specifically said that it will be included at no value if the employee is simply entertaining the employer's clients. So this is going to be a nil amount. The company runs cafeteria. On average, Twix has a meal there twice for 48 weeks a year. She saves approximately 10 rand per meal compared to what she would if she had paid to eat at a public place. So this is that low or free services because this is at a cafeteria that has been provided by the company, then this will be included at a nil value. So let's quickly go through the solution, you guys. Okay, so you have your 13th check, your salary 30 and your 13th check that will both be included in your gross income in terms of paragraph C, your pension fund fringe benefit where the employee has contributed, and the loan that the employee provided to you, a low interest loan. You need to calculate for the loan for the first 153 days because that's before those capital payments were made. And for the other days where the capital payments had already started being made of 10,000. And you need to calculate the right of use of a car. So that will be 130 multiplied by 115 multiplied by 85%. That this is because the BMW was initially used by another person, so you need to apply a depreciation of 15%, and this is stipulated in your tax legislation. So you need to multiply that by 3.5% because this is not subject to a maintenance plan, and multiply by the number of months that the employee had a right of use to the vehicle for, which was for a period of 7 months. So the employee then subsequently got a right of housing, which was the right of use of the apartment, the house that was provided by an employee. So you need to say A being the remuneration proxy that was given to us, less B multiplied by 17 over 100 because they are renting a 3-bedroom apartment or 3-bedroom house, and they are not paying for any furniture or electricity, and multiply that by 11 over 12 because the right of use was obtained from the 1st of March until the 31st of January. Meals at a cafeteria, they will be at a no value because they were had at a cafeteria, right? You need to also include the other amounts that will be included will be the entertainment allowances, and entertainment expenses will not be included because they are prohibited to be included in terms of section 23M. Then for the travel allowance, to actually calculate the travel allowance, you're going to take your travel allowance that the employer gets for the full year, which for that full 5 months period, which is the 3.2 multiplied by 5, and the cost per kilometer. So you need to use the tables to calculate the fixed cost, and that fixed cost needs to be divided by the total kilometers, and then apportioned for the number of days with under which the employee got the benefit. From there, you need to add your fuel that will be on that cost, that will be on the cost table, and add your maintenances, and then you will get your total cost per kilometer. You need to multiply that by the kilometers that were actually for the business kilometers. So for the pension contribution that has been made by the employer and the pension contribution that has been made by the employee, you then need to calculate the section 11 section 11 cap F allowance or deduction. So the deduction will be the lesser of that 60,000 rand or 350, and the lesser of is going to be that 60,589. And since our contributions are higher than that, then the deduction will be limited. That's 60,589. All right, so I'm just going to read for you guys then the notes from the examiner. The notes from the examiner say that you need to remember to use the total kilometers that were driven, not the business kilometers. Because the fixed cost gives an answer in rand and the fuel and maintenance gives the answer in cents, you need to either convert the fixed kilometers to cents or convert the fuel and maintenance costs to rand. And I think you guys would remember that from my notes, I said you can multiply by 100, and that is to convert the cost, the fixed cost that you're gonna get from rents to cents, right? So then it continues to say, I find it much easier to convert the fuel and maintenance costs from the table into rents. The choice is, however, yours. Remember also that rounding off at a different point in the calculation could give slightly different answers. Again, this does not matter. When we mark your answer, we are looking at the correct application of the principle. The Act provides that where someone else has had the use of the vehicle before the current user, then the determined value for the purposes of calculating the fringe benefit can be reduced by 50%. And that is why we saw that the determined value for the right of use of that BMW was multiplied by 80%. That was to take into account the fact that it has been used by someone else before. So it needs to be reduced by 15%. So let me just continue to read. So reduced by 15% for each completed period of 12 months using the reducing balance method. If the cost of the vehicle presents 100%, it is reduced by 15%, then the balance remaining is 85%. It is therefore a shortcut and completely acceptable mathematically to multiply the cost by 85% for each completed 12 months. You will arrive directly at the determined value that you need for your calculation. I hope that was understandable. So we're gonna now move to 11.2. You have Jean Bannister, Jean Bannister's employer, a company that has given him the choice to select as of the 1st of March 2023, either the free use of the company car for private purposes, for private and business, or a travel allowance. Jean would keep a detailed logbook, and he estimates that he will travel 35,000 per annum, of which 15 would be for business. So when they say that the person will keep a detailed logbook, it means that you can then use actual costs. So you can use actual cost as you can use as actual cost. So meaning that oh my God. Has the option of choosing between deemed cost and actual cost, right? So that's what it means. So they have already estimated that he will travel 35,000 for the entire year and 15,000 will be for business kilometers. This applies for travel allowance and the use of the car, right? So should he choose to the travel allowance, he will receive a allowance of 7,860 a month. He will purchase a new car on the 1st of March for 180. In order to assist him to purchase the car, the company will grant him a loan of 100,000 on the 1st of March 2023, and an interest rate of 1% per annum will be charged. And you should assume that the official interest rate is going to be 8%. The capital will be repayable in 6 months, in 6 monthly payments of 12,000 each. The first payment was the 31st of August 2023. So you need to take that into account when we are doing our calculations. And the expenses for the period to be incurred will be as followed. The fuel costs, the maintenance, license, and insurance, and use of the car, the tax. The car that he will use was purchased by the company 2 January 480. The car will be purchased specifically for him, so it was never used by anyone else, so we don't need to then depreciate it by that 15%. The car will be purchased specifically for him, and no one else will have the use of the vehicle. The car was brought under a maintenance plan for 5 years or 100 kilometers. So we need to calculate whether Bannister should choose the travel allowance or use the company's car based of his estimated. Compare only the tax implication of the two possibilities in respect of the year of assessment ended 29 February 2024. So let's just quickly go through the solution for this. So if Bannister was going to take the travel allowance, he was going to get an allowance of 7,860 for 12 months. And from there, you need to less your business expenses. So your business kilometers were given to us to be 15,000 that he estimated that he will travel. So as I said, when they say that the taxpayer keeps an accurate logbook of the kilometers that have been traveled, it means that the taxpayer can then be able to use actual expenses or actual costs or the deemed cost. The taxpayer has a choice to choose between the two, and the taxpayer will always choose the higher of the two, because a taxpayer would want to be in the most advantageous tax position. So wear and tear of the car that he would have purchased will be 207 as given to us, and he will then divide this by 7, because I think that it is the period, the wear and tear period that they gave us. I'm in 850, 1 March. Okay, let's just look for it. So should he choose the travel allowance, he'll receive the 7,860, and he'll purchase a new car for 180, excluding VAT. So you need to add VAT. And in order to assist him to purchase the car, they will grant him a loan from the 1st of March at an interest rate of 1%, and assume the interest. The capital will be paid in 6 monthly payments. The first payment is due on the 31st, and the expenses were as follows. So you need to use that note in the tax act that tells you the number of years that it will take to depreciate a car, your note 7. Right, so we need to then gross up the value of the car with the value of tax, and you also need to depreciate it for a period of 7 years. So that 180 multiplied by 115% will give us the 200, the 207. And you then need to add your interest on the loan, because it is a cost on the car as well, and take into account lessing the capital payments that the taxpayer is going to make in the current year, and add all the other costs that were given to us, the other expenses that were given to us in the question, which were those fuel costs. Then you take those full total costs, divide them by the total kilometers, and multiply them by the actual business kilometers to get, let me do it myself, 1 point. And then you calculate the kilometers, the rand per kilometers that you will multiply by the business kilometers. Or you choose the deemed cost, since the car is 180 plus the 15% because it was after tax, then you need to determine the fixed cost. When you go to that cost table, it will be the 86,000 divided by the total kilometers. You need to convert your kilometers, your fuel and your maintenance from cents to rand to get the total deemed cost at 400. Since the higher of the two is the deemed cost, that's the one that we are going to use, because the taxpayer will choose the highest between the deemed expenses and the actual expenses, and then we have to multiply those deemed expenses by the total business kilometers that have been traveled. And you guys have to remember that when the taxpayer buys this car, they will then have an interest-free loan. So you also need to take into account the interest-free loan, the fringe benefit of them receiving an interest-free loan. And as you remember, they told us that on the 1st of August, the taxpayer will have to then make a capital payment of 12,000 rand. So you need to calculate the interest from the time they did not make this capital repayment, and from the beginning of the year until the time they did not make this capital repayment, and then calculate from the time they get a capital repayment less the capital repayment, and you need to apportion these interests for the number of days. So if the taxpayer would then take this company car, then their total tax treatment would be that 94,000 less the 72,000 rand. That will give them 94 less the 72. That will be the travel allowance that they will include. And additionally, the taxpayer would also then have to include the fringe benefit of 28,000. Is it 28? No, it's 3,000. 3,519 plus 3,046. So then the total tax treatment would be, the total effect on the taxable income will be this 28,000 rand. So if the taxpayer then uses the company car, they will then get a fringe benefit of the value of the car, gross it up for the interest for VAT. And since it is subject to a maintenance plan, you need to multiply it by 3.25, and it will be received for the full year of assessment. So you need to multiply that by 12. And since this car is used partly for business purposes, you need to apportion that. You need to get that business travel reduction, which we spoke about when we were doing the notes. And the business kilometers reduction will be your business kilometers divided by your total kilometers, multiplied by that cash equivalent that you would have gotten in when you were doing your calculation. And then what you include in your taxable income would be the 46,000 rand 131. So it would be most beneficial for the taxpayer to then take a travel allowance of 7,890, if I'm remembering correctly. it will be better for them to take this 7,860 travel allowance and that interest-free loan, because their tax, their inclusion into their tax would be lower than than compared to if they would then take the right of use of a company car. Right, I hope that was understandable. So for time purposes, I'm just gonna move to 1.3. I think 1.3 is a good practice question because it has a lot of concepts that have been tested, and with the upcoming test, I think it would be a good practice to dive into 11.4 because it serves almost as a revision. You have Jason Judah, who is 45 years old and is married out of community of property. So you have a natural person who's younger than 45. So in your head, you're thinking about your natural person's provision. You're thinking about your interest exemptions. You're thinking about the fact that when you calculate tax for a natural person, it needs to be done on a tax table as opposed to just a fixed rate of 27% for a company. This person is married but out of community of property. He is employed at Jet Express Airways, a local airline. The following information relates to Jason Judah's income and expenditure for the year of assessment 29 February 2024. In his position as a marketing manager for Jet Express Airways, Jason Judah receives an annual salary of 580. So this annual salary of 580, that salary will be included into Jason Judah's gross income in terms of paragraph C. Then Jason Judah had to travel for business purposes and also received a travel allowance of 88,000. So this will be the total travel allowance that he has received. The vehicle he used was purchased under a finance lease on the 31st in November 2024. The cost of the vehicle was 254. So let's highlight the cost of the vehicle. And a total finance charge that has been spread over 5 years amounted to 116. Jason kept an accurate logbook of expenses incurred in connection with the vehicle. During the current year of assessment, he spent 30,700 on fuel, 12,200 on capital repayments, and 16,900 on the vehicle insurance. Jason traveled traveled 29,200 kilometers. In total during the year of assessment, he kept an accurate logbook of the distance that he has traveled. So it means that he has a chance to claim he has a chance to use actual costs or deemed costs. From the 1st of August 2023, Jason also received the right of use of the employees, the right to use a new company car for private purposes. The cost of the vehicle was 186 VAT exclusive, so need to gross it up for VAT. And all fuel and maintenances are paid by Jet Express. This car is not subject to a maintenance plan. So since it's not subject to a maintenance plan, this needs to determine the cash equivalent or the cash value. It will be to multiply it by 3.5 and not 3.25. And this right of use was this person got it. Jason got it on the 1st of August, so that will be 7 months from the 1st of August until the 28th of February. Right? During the previous year of assessment, Jason borrowed a sum of money from his employer in order to purchase a house. The capital outstanding on the 1st of March was 98,000 Rand. His employer first charged him an interest rate of 1.5 per annum, right? That is the interest rate that he has been charged. I assumed that the official interest rate was 6.5 on the 1st of March 2023. So let's also highlight the official interest rate and assume that the official interest rate was then later increased to 7.5 on the 1st of September 2023, and thereafter remained unchanged for the remainder of the year of assessment. Jason made no capital repayments during the year of assessment. So because the interest changed, we need to also then take that into account into our calculation. Did I calculate this correctly? So 1 March until 31 September. Let me calculate that. So yeah, that is 184 days from 1 March to 1 September. And from 1 September then until 28 February, that will be 182. 182 days. So you then need to show that there was a change in the interest rate. You need to show that for the first half it was 6.6%, and then for the last half where they then increased the interest rate to 7.5, it became 7.5%. Jason Judah received the following investment income: a dividend that has been received in relation to a United Kingdom unit trust, and it is not fully exempt in terms of Section 10 Cap B2. So this needs to be included in Jason's income in terms of the gross income definition, or just included. And an exemption, Jason will then qualify for an exemption in terms of Section 10 Cap B3, I think, because it is not subject to a full exemption. Then it means that it will then be subject to a part exemption of 25/45. Interest that has been received from a South African fixed deposit, and this is not a tax-free investment. So you need to include that interest in terms of the gross income definition. And since Jason is only 45 years old, their interest exemption is limited to 23,800. So they'll then get a Section 10(1)(I) exemption of 23,800 on this interest. On the 1st of July 2023, Jason's employee gave him the right to use a company laptop for private use. Jason had the right to use the company computer until the end of the year of assessment. The company purchased the computer for a cost of 17,000 Rand. The market value of the computer at the time when Jason received it was 14,700. Jason paid no consideration for the use of this computer. So it will qualify under this, the right of use of an asset. And because this asset is being owned by the employer, then Jason will include the fringe benefit at the lesser of the cost price times 15%, or at the lesser of or at the market value multiplied by 15%, and then apportion that for the number of years, the number of months that it was used for in the current period. So since we know that in this case, for receiving the rights of use of the computer, The lesser of, you need to show the marker that you know that it is the lesser of the cost of 17,500 or the market value of 14,700. The lesser of the two is the market value of 14,700. You need to multiply that by 15% and then subsequently apportion. During January 2024, Jet Airways, Jason Jutter's employee gave him free return tickets to Cape Town for himself and his wife. The cost to the employee were 2,050 rand. The market value of the tickets were 4,950. So this is also a fringe benefit. To cover himself against the risk of injury, Jason Juta paid a income protection insurance premium amounting to 7,320 during the year of assessment. In terms of the insurance policy, any amount paid out will not be taxable. So this premiums that are being paid to this will not be deductible because they do not result in income. So we would say that it is not in the production of income as defined. Jason Juta, his wife, and 2 children are members of a registered medical scheme. His youngest daughter has a disability as defined. Ms. Juta's medical aid contributions for the year of assessment were 31,000. His employer paid no contributions on his behalf. So you need to think about your 6-cap-A medical rebate, and for your 6-cap-A medical rebate, it will be 364, if I'm remembering correctly, for the first 2 dependents and 246 for the subsequent beneficiaries. So we need to calculate 364 times 2 plus 246 to calculate the total medical rebate, which we will look at in the solution. Jason Juta is not a member of a pension fund and he does not make contributions to a retirement fund. During the year of assessment, these contributions totaled 37,000. His total contributions totaled 37,000 for. He does not make any contributions to a retirement fund. During the year, these contribution totaled 37,800. Contributions totaling 3.2 were allowed in the previous year of assessment. And we need to assume in this case that Jason Juta's remuneration for the purposes of this question is 689. You need to calculate Jason Juta's normal tax payable after rebates and tax credit. So you need to calculate tax payable, tax tables, rebates. So that primary rebate, you need to calculate medical rebates. Yeah. So let's quickly go through the solution. All right, so Juta's salary of 580 will be included in their gross income, and the use of the company car for a period of 7 months, which was that 186, and then we had to gross it up by the VAT so that it can include VAT, multiply that by 3.5, multiply that by the number of months that it was actually used for, which was for a period of 7 months. And then this person got a low interest loan. For a low interest loan, then we need to calculate the difference between what they would have been charged if they were charged interest at the official interest rate, less the interest rate that has actually been paid. And you need to apportion this for a number of days, as I showed you in the analysis of this question. And you also need to calculate it for after they've increased the official interest rate. So that is going to be an inclusion of 5,387. The rights of use of the company, computer. So we decided that the lesser of the market value and the cost price would be that 14,700. And because they started getting the benefit to the right of use of this computer on the 1st of July, that will be for a period of 8 months divided by 12. So the receipts of complimentary air tickets will be at a no value. The destination is in South Africa, and employer in business of transporting passengers for rewards. Then you need to include the foreign dividends that the person got, that Jason got for this these dividends of 8,528, and subsequently exempt them at that part exemption rate of 25/45, as well as including the local interest rate at 26,915, and subsequently exempting 23,800. I think I used the correct one. I think I said 23,600. So it's 23,800. And that will be your income. From there, you need to include other income, which will be your travel allowances. So the total travel allowance that the taxpayer was receiving was that 83,000 Rand. And then you need to calculate your deemed cost per kilometer and your actual cost per kilometer. So your fixed cost, to determine your fixed cost, you need to use the cost price of the car, and it will land you at a fixed cost of 86,958 divided by the total kilometer. And this was gotten for the full year of assessment at the fuel cost, the maintenance cost, and that will then give us the total cost per kilometer. And in this question, they calculated in percent, and you need to choose the higher of the two. So to calculate the full actual cost, it would be the cost of the car divided by 7, which will be the normal wear and tear period for a car, a motor vehicle. And you need to add the fuel, insurance, finance charges that were for a period of 5 years. So you need to divide them by 5 to get for the current year of assessment, and that will give you the total vehicle expense for the year. So to then get the actual cost per kilometer, you're gonna take those total costs divided by the total kilometers multiplied by 100 cents to convert it to cents, and you choose the higher of the two. The higher of the two is obviously the deemed travel allowance, the deemed cost, and that will be 529 divided by 100 cents multiplied by the business kilometers, and that will give us 28,698. And your insurance premium protection costs that the taxpayer was paying are non-deductible because they are not in the production of income. They do not result in income as defined. Right. So you then have your subtotal. You need to then take into account your retirement annuity contributions. So your contributions for the full year that were amounting to 37,800 plus the denied allowance, the denied allowance the denied allowance in the previous year of assessment, and you need to limit that 41,000 rand to the higher of the remuneration which was given to us, or the taxable income of 675, which is that subtotal. And it should be limited to the lesser of the 350, 189, which is the second calculation, and 675. So since our total contribution plus a denied allowance, a denied deduction in the previous period are 41,000, they are less than what the taxpayer actually, they're less than what the taxpayer actually paid, then the taxpayer will get the total deduction of that 41,000 rand. So we need to calculate the tax per the normal tax table. So we can just research the tax tables. So tax table for 2025 and 2024 have not yet changed. So they fall under 634. That was the taxable income. So it falls under this tier in the tax table, and then we calculate the tax table as such, less your primary rebate and less the medical rebate. And you need to add qualifying medical aid expenses, medical aid contributions, which were 31,360, and there were no, and then less the 3 times your medical aid rebate for 6 cap A, adding your qualifying expenses, and there were no qualifying expenses. And then we will not have any 6 cap A rebate. So let's do one more question and then close it off. Let's see which one would be. We would be able to cover in the 20 minutes that is left. I think we should just do 11.5. So you have Promise and Precious Boy who are married in community of property. So these are the two people that we're dealing with in the question. They're married in community of property, and remember that you need to apportion any income that is passive between the two of them. Promise is a South African resident and retired due to poor health, and he turned 63 on the 30th of November 2023. Promise worked for a real development, a South African property development company, and his information below is relevant. So he had a salary of 630. So this will be included in his gross income in terms of paragraph C. Total pension income that has been received also has to include in terms of the gross income special inclusions and loan received from the employer. So with the loan received from the employer, Promise received the loan from his employer on the 1st of March 2023. Promise used the loan to build an additional garage to his residence. The term of the loan stipulates that an interest is charged at 3% per annum, and the loan repayment is 50,000 every 12 months. Promise repaid the entire loan when he retired. You may assume that the repo rate that was 7% per annum at 31 March has remained unchanged. So you need to include an interest-free loan, which will be at the 200,000. This loan was promised, and he repaid the total loan before he retired, which was 30 November. So you need to calculate the loan. Fringe benefit. at 7% less 3%. And use of the company motor vehicle. Promise was granted the use of a new company vehicle 5 years ago. The vehicle cost was 451 on the 1st of March 2018, 5 years ago, when it was granted to him. And the motor vehicle maintenance expired on the 28th of February last year. During the current year of assessment, Promise kept an accurate logbook traveling up to the date of his retirement. He indicated that he traveled 6,000 for private and then 12,000 for business. Promise had to pay for all the fuel relating to private travel, which amounted to 8.2. Promise also incurred maintenance cost of 1,614. Need to take it to this account when we calculate the value of the fringe benefit. When Promise retired on the 30th, his employer made him an offer to purchase the vehicle for 120, even though its market value was 150. Promise accepted the offer and purchased the car. So this is a fringe benefit because he got this car at lesser than market value. So the difference between the market value is a fringe benefit. On the 1st of April 2023 to the 31st of April, Promise's employee allowed him to make use of some of its equipment in order to complete an additional garage at his residence. The employer purchased some of the equipment 3 years ago at a cost of 100,000. The market value was currently 90,000 rand. The other equipment Promise used is leased by the employer at 5,000 rand per month and has a market value of 325 and an original cost of 4,000 rand. So this is going to be a fringe benefit for the use of your employer's asset. And if it's owned, if it's owned, it's going to be at market value. Cost price, and if it's leased, I think it is amount of rental payable. Promise purchased the house during disposal of a primary residence. So Promise purchased the house during October 2002 for 700,000. From 1 March up until 1 October 2023, he used 5% of his home as an office in order to administer the rental activities. Promise office expenses are deductible for income tax purposes. During October 2002, a lapa and swimming pool were built for 150. The house was sold on the 29th February 2024. Promise received 1,940,000 after deduction for the sale. and a agent cost of 3%. So you need to take into account the proceeds of 1940 million, commission costs, which will be less from your selling price of 3%. The cost of the house would be 700,000. That's the swimming pool of 150. And you also need to note the fact that it is a primary residence, paragraph 45, and 5% was used for business. Right. Promise purchased the house in February 2014 for 800,000. He paid transfers and legal duties of 15,000. So that will be added to the cost of the house. He always let the house to tenants. During the year, the perimeter walls were extended from 1.8 to 2 meters for a cost of 80,000 rand. These extension costs are improvements, need to be added to the cost. The cost to draw up the plan and the necessary municipal approval was 9,000 rand. A garage was added during April for a cost of 200,000. The house was sold on the 1st of October 2023 for a cost for 1.7 million. These would be the proceeds for the sale of this house. Agent costs and commission costs were charged at 4%, and that needs to be taken into account when we are determining our costs. Promise repaid an outstanding bond to the bank of 70,000 rand. Home and office expenses for the year were as follows. The rent for 1 March to 30 September was 11,500. Promise and patients lived in a primary residence from the 29th February up to 29th February and let the other residents up until the 30th. Promise set up an office which comprises of 5% of the primary residence. Details of the home office expenditures and rental receipts and rental expenditure are as follows. The rental receipts from the 1st of March to the 30th of September 2023, the rent of 11,000. The rent for February received 5 March, rental income March to September of 12,500 per month. And these are the office expenses and rental expenses from the 1st of March to the 30th of September. The property rates and taxes, electricity, monthly levies, payments to financial institutions for the bond wouldn't be included, but the interest would be deductible. Installation of prepaid electricity, agent cost, enclosure of veranda, repairs of damages caused by the tenant, security levies, deposits, refunds to the tenants amounted to 12,000 rand, of which 3.2 was refunded to the tenant. The medical aid expenses are up to as follows. The contributions would be 45,000 rand. Premises medical aid contributions from 1 September to 31 December, there was no contribution. So Promise only stopped contributing up until the 30th of November. So we should take that into account when we calculate our 6 cap A medical rebate. And then the Promise employers medical aid contributions of 30,000 rand. So this is a fringe benefit and it will be included in Promise's income. Okay. So Promise contributed 8% of his salary towards a pension fund, and his employer also contributed the same. Promise further contributed 3,000 per month towards a retirement fund for the entire year of assessment after he resigned. You may assume that Promise remuneration is 1,049. Precious salaries for the year were as follows: salary and a JSE listed investment. So this is passive income, so it needs to be divided between Promise and his wife. So let's quickly go through the solution. Okay. So we're doing 11.5. So Promise needs to include the salary of 630 and also the pension income of 130. The low interest loan also needs to be taken into account by Promise. So Promise was given a loan, let's go, loan to employer, and the repo rate is 7%. So to calculate the official interest rate, you need to add 1% to the repo rate. So the official interest rate would be 8%, and Promise was paying the loan at 3%. And since he repaid the full loan when he retired, then you need to apportion that interest for that year of assessment. So the right of use of the motor car that was owned by the employer would be that the original cost multiplied by 3.25 because it was subject to a maintenance plan, and then multiply that by 9 months. So we need to then less from the business use, the kilometers that were actually traveled by Promise for business purposes. You need to use that to reduce the fringe benefit, and from there need to reduce by your private fuel cost, your maintenance cost, and you need to reduce by your maintenance cost and your fuel cost multiplied by your private use kilometers to reduce the fringe benefit. So the acquisition of employer-owned motor assets. So the market value of the asset was 150 and Promise only got it for 120. So the difference between the market value and the price that the Promise actually paid would be a fringe benefit. So the use of the employer equipment, since the other one was owned by the employer, we need to take the cost that was incurred by the employer, the cost price incurred by the employer, multiply by 50%, and then apportion it for the 2 months period of which it was used, and the lease payments that were paid by the employer. Right, and Promise had a rental income February rent received in March. It actually accrued in February 2023, so it wouldn't be in the current year of assessment, and the rent that has been actually received in the current year of assessment from March to September will be included. So since the rent is a passive income and Promise is married in community of property, it needs to be apportioned. And the Paris's employer then paid Promise's employer paid for medical aid fringe benefit. But if you guys could remember, when we were doing the notes, we did mention that a medical rebate will not be paid a medical rebate will be included at a no value if the employer made that if the employer made that contribution after retirement. And employer pension fund contribution, the employer made a pension fund contribution of 8% for Promise, then that needs to be included in Promise's income as a fringe benefit. Additionally, Promise had an income of real estate dividends. Since that it is a passive income, it needs to be apportioned between the two of them. And then you have your office expenses. Let's open the question as well on the side. You have your office expenses of 21,000 rand, 24,000 rand, 21,000 rand for electricity, 24 for 21 for property taxes, 24 for electricity and your monthly levies, as well as the 5,000 rand for the security levies, which will be deductible. And the low interest loan that has been paid, plus the fringe benefit, also needs to be taken into account, because that low interest loan was used for the business that was run by Promise. The rates and taxes will need to also be taken into account. The monthly levies, the bond repayments, the capital part of it is not going to be deductible because it's capital in nature. Electricity meter, they mentioned it. Installation of the electricity meter, it is capital in nature, so it will not be deductible. The enclosure of the veranda is also not deductible because it is capital in nature. The repairs caused by the tenants, the security costs, the tenant's deposit utilized to defray damages will also be taken into account. And all these expenses will need to be divided by 50%, the ones that are related to the rental business, because they are related to a passive income. So they need to be apportioned between Promise and the wife. Right? So we then need to calculate our taxable income. We need to calculate the capital gains from the sale of the business. So since the proceeds include a commission cost, that needs to be removed when we calculate our proceeds, because those commission costs are not going to accrue to Promise, but the commissioner. And then your base cost would be your purchase cost, your swimming pool, your agent commission, and you'll get your capital gain of 1,090,000. And you need to apportion the business use being 5% of the business. 5% of the business was used for business purposes, and the other part that didn't relate to business use will be subject to the 2 million exclusion in terms of paragraph 5. So the sale of the let residence will be the proceeds of 1.7, and your purchase price, your transfer, your perimeter walls, and all the other capital cost that has been incurred will be added to the cost of this let resident, and the capital gain will be 459,000. And since this is as a result of a property that resulted in passive income, it needs to be apportioned between Promise and his wife. And after apportioning it 50-50 between the two, you need to take into account your annual exclusion and your inclusion rate of 40% and include the total capital gain into the taxpayer's income. So you need to less your retirement contributions, which will be your Section 11 Cap F deductions. Look into the fact that your employer contributed 50%, 8% of Promise's income in terms of a retirement fund, and he did also the same. And after that, Promise then contributed 3,000 additional to what the employer is contributing for them. So you then need to calculate the limit, and since the actual contributions that have been incurred by the taxpayer are less than the contributions, then the taxpayer will be able to get a full Section 11 Cap F deduction on the total contributions that they have incurred. So your taxable income will be your 968, and you need to use your tax tables to calculate your tax. So since it's 968, it is within this tier. So you need to calculate your normal tax payables and your primary rebate, your what is this? Primary rebate, medical aid rebate, since the two beneficiaries of Promises medical aid will be him and his wife. The medical aid rebate will be 364 multiplied by 2, and then the additional medical aid 6 can be medical aid rebate. So that will be your contributions that were made by the employer, that were made by Promise, and the contributions that were actually made by Promise's employer, and less from that the 6 cap A rebate. That will give us 63,793, and multiply that by 33.3%. That will then give us a rebate of 21,000 rand. So that will be the tax payable after lessing all the rebates. So even though the maintenance contract has expired, the percentage of 3.25 must still be applied. The 115 months relates to the number of months that the 5% of the residence was used as an office for work from the 1st of March 2014 to 1 October 2023. The 269 months relates to the number of months the residence was occupied for capital gains purposes from 1 October to 29 February. The use of employer-owned and employer-led equipment was used to erect the garage, thus it forms part of the base cost. So this will be the end of today's session. Thank you everyone for joining in.